Anthony Smith, lead
Zach
economist at FreightWaves.
That's me.
That's you.
You're Zach Strickland.
Ah, right. I forgot. I'm Zach Strickland, Director of Freight Market
That's
Intelligence at FreightWaves. And here we are on another edition of Freightonomics. Thanks
with
for tuning
another amazing intro, with that music, this background down here. It's just a lot going on right now. We have, it's been revamped. A new breath of air. If you're watching on either LinkedIn or Facebook right now. Speaking of which, we are on LinkedIn streaming live right now. So if you are watching, feel free to jump in and chime in. We have Eric Serta, I think just said all present and accounted for.
There we go.
Jump in on the conversation if you want to,
Yeah, if you're watching between 2 and 2:30 p.m. Eastern Daylight Time on the East Coast.
Yeah.
That means you're watching us live. So otherwise, thank you for listening on the podcast and the recorded version. So Anthony Smith, we are, you're fresh off the car ride, 14 hours from Boston.
I don't know what you're talking about, Zach. But yeah, shout out to Ray Team for doing a great job on the vehicle. And it's been an amazing ride all along the coast.
14 hours straight through. So you would have been over your hours of service.
I would have been.
You were not allowed to do that. So you did Boston to Chattanooga from 7:45 p.m. last night.
Yeah.
And you got here right in front of FreightWaves Now this morning.
That's right. Couldn't miss it for the world.
I was very appreciative.
Pulled right in.
So 10:15-ish this morning, you were definitely driving illegal.
Yeah. Yeah, so very appreciative for my paper logs that I can But no, yeah, it was a pretty straight shot. Took forever to get through Pennsylvania and Virginia. I'm sure many drivers, if they are listening right now, they're just like, chump.
You're nothing, dude.
Exactly.
You got nothing, except for the fact that you were able to get out of the Northeast.
Yeah.
That's a very rare occurrence. So congratulations. You made it out of the Northeast corridor without having to go right back in.
Thank you.
That's actually gravy. If you can get out of the Northeastern corridor into the Southeast where there's some freight movement that'll get you moving around the country, then...
And I'm at Freight Alley. What better place to be than Chattanooga,
Up on that 75. So, Freightonomics, welcome to the show.
Oh, that's right. It's Freightonomics.
This is where we discuss, economics, supply chain, how it all interacts, relates to freight, relates to the, trucking movement, but it's all interconnected. It's not necessarily all about trucking or brokerage or shipping, freight, or transportation. It is all an interconnected, intertangled mess of stuff that happens. And of course, this year has been one of the craziest that we've seen so far. And on today's show, we're going to discuss some of the things that are interacting with freight rates or transportation rates and the domestic freight market. It's been one of the most, I guess, a question that I get asked quite a bit is, what's happening to capacity? Why are these brokers driving down rates? What's going on with the market? Like, why is it so volatile? Are rates going up? Are they going down? How are they there's so many factors here involving rates, and I think a lot of people don't understand all the interactions that occur that drive a lot of, and of course I'm going to talk more about the domestic trucking rates,
right?
Because that's my specialty and it's easier for me to discuss. But we also have a lot of good data in that regard. But also, Anthony Smith, we've had some interesting developments with the economic recovery. Now,
we had some stuff.
It's, to me, this is yet again, so the common theme, I look for patterns. As an analyst, you always look for patterns in data and things. And certainly, I was actually a psychology minor. So one of my favorite patterns to look for is consistent human behavior. And one of the most consistent human behaviors we've seen is they have, and myself included, I'm going to go ahead and just lump myself right into there. We expected this to be a very slow, drawn-out recovery process.
Right.
Yet, analysts expected retail sales growth to be, 5%?
Somewhere around there, I think.
Around 5 to 6%, somewhere there?
Yeah, that sounds about right.
And what did we get?
So in the most recent month, which I believe we have it for May. So we're looking at May retail sales, and it was a 17.7% jump.
And that's off of a 23% drop from March to April?
Yeah, it was a pretty significant drop, and I think that's kind of where my sticking point is with some of this latest economic data is we, I think, expected April to be the trough for most macroeconomic indicators. And so the thing to really keep in mind is not mixing up the changes and the levels, because we can have these drastic changes where it was at these lows that were hit in April, and because it was so low, we're going to have seemingly rise in the levels. And so it's all good to keep that into perspective. So, for example, retail sales was up 17.7%, but still down 6.1% year over year. So it's important to, we see that rise, that rebound from that absolute trough that was April, but there's still a long way to go. So it's encouraging to see that double-digit month-to-month rise, but knowing that we still are far behind where we were this time last year is also something to keep in mind when we're looking at these numbers.
Yeah, I think that's a valid point, especially, again, everybody expecting a slow, drawn-out recovery. Again, I'm in that same boat. Craig Fuller obviously disagreed with me, and he won the outcome. But, this is good news in my mind. Yeah. This is still good news. It means that even with all the stuff that's going on in 2020, which has turned out to be a natural disaster on its own accord, we're getting a much stronger recovery signal. It looks like, speaking of natural disasters, a natural disaster outcome. So natural disasters, of course, hurricanes, earthquakes, tornadoes, they tend to have very sharp, acute impacts into local economies. In our version of this, it's a macro economy. But it is very short. As quickly as it drops, it comes back just as fast. So in my mind, this is another supporting statistic for a V-shaped recovery. Do you agree?
Meh.
On the retail side for sure, but it's obviously we're going to, we've got some other numbers that say that not everywhere is it a V-shaped recovery.
Sure.
Is that accurate?
Yeah, and I love looking at the month to month, but I always go back to that year to year. Like, okay, this is nice, but what were you doing this time last year? But and I think it's a good point that you mentioned, like the natural disaster aspect of it, because this is something you brought up, I think, months ago when this all first kind of kicked off, really kind of framing this as a natural disaster and how that typically kind of evolves compared to set frameworks of an actual cyclical recession that's been in the works for quarters and quarters and quarters and gets compounded, and that's a little bit more harder to come out of. When you have sudden shocks like this, typically you have sudden shocks back up, and I think that's one of the things that we're seeing, especially on your side when we're looking at freight volumes, that shock back up after everything is really kind of starting to get back online, and we're starting to see, of course, retail sales and industrial production starting to mildly improve, those wheels kind of turning on the road.
So industrial production, that you mentioned that. Now, that's been a struggling sector of the economy. Before COVID-19 and all that happened, the industrial economy had really been struggling to get going.
Right.
We were starting to see the initial signs of it maybe getting back on track slightly, but it certainly wasn't growing robustly by any means.
Right.
What are we seeing now? We just had that release, correct?
That's right. So industrial production, just as you mentioned, was an area that was definitely struggling. A lot of it, business uncertainties, and especially when we're looking at a separate measure, non-defense capital goods new orders, business investment was low, business activity was low, and that really kind of declined through the latter half of 2019. And so in the most recent month, we saw that there was an increase of 1.4% from last month. Mm-hmm. But the thing is, last month hit a historical low.
We're getting better than the worst.
We're better than the worst. And so it's a tick up from the absolute worst that's ever been recorded, and still down 15.3%. So it's, again, that trough has likely been reached. Yep. And we're starting to see some upward movement. Of course, I like to see consecutive month-to-month movement to kind of call it or to be indicative of a trend. But I think it's safe to say of our expectations of April really being that trough.
Now, this feels like this does feel like a meh. This feels definite, like retail went down 23%, up 17.5%. Industrial production down 17%, up 1%. This is definitely one of those like, oh, we did not recover out of the industrial side whatsoever. And this one is very important for freight movement. To me, this is a critical sector for the freight transportation industry and the economy in general. If they want to get back on track and have sustainability, the industrial economy has to recover, for us to have any kind of growth in the economy and sustainability moving forward, especially on that freight transportation side. The industrial economy, a lot of manufacturing, a lot of utilities in there. If you don't have that business investment, you don't have a lot of big stuff moving in the United States right now. Now, the consumer has really been driving a lot of, the economic growth here the last several years. But the industrial side is really where you can have some of that more efficient growth, sustainable growth. Consumers are fickle, as I've noted, with your sentiment indexes.
It's important.
I'm a consumer myself, so I understand. I'm literally applying myself to that same population, so I know that it's a little bit emotional there. But at the same time, they've done a good job of keeping the economy, really up while a lot of the industrial movement is down. Now, I guess my question to you, Anthony Smith, is we have seen such a dramatic, amount of volatility with supply chain management here in the last year, 18 months. Started with a trade war, with China, and now we have this, things were starting to get a little bit more, back on track, and then all of a sudden COVID-19 happens, again, originating in China. Policies fall apart, relationships fall apart a little bit. We're starting to see a little bit of those similar patterns in freight where we see a lot of trade war, back and forth, potentially starting back up again, especially once this all clears up, hopefully sooner rather than later. But, are we going to see more manufacturing and industrial come back to the United States?
We could, but nothing that's going to, I think, be deeply impacting. And so when we're looking at manufacturing in the U.S., it's not that we don't manufacture a whole lot. It's that our manufacturing a lot of times is automated. So when we do move manufacturing back to nearshoring, it's not going to be something that's going to supply a lot of jobs or something that's being on a mass infrastructure scale. So the thing is I think we chatted about this earlier in Freightonomics and maybe some other platforms, but China is such a massive resource, and to try to replace that much of an infrastructure is very difficult. We can't just replicate that and copy and paste it into Mexico and have our nearshoring with our southern neighbors here, or copy and paste it into Nebraska. It's just they are perfectly set up, and so that's going to be very difficult for them because. Or to replace them. I think we've heard talks of India probably coming up, but China's been built and honed their specialties around being the most price efficient and cost efficient and accessible manufacturing outlet for trading partners throughout the world.
Yeah, I couldn't agree more. The old adage, water takes the path of least resistance, and that's the way that business works as well. If you present businesses with, a cost structure that's more favorable, and they get similar quality or not as much, obviously there's a trade-off there in quality, but similar quality for less cost, they're going to take it. And I think that's, again, to your point, the infrastructure in China is just so overwhelmingly set up for doing what it's doing as compared to, say, a Vietnam, an India, Mexico even. We just don't have, that's not a switch that you can flip overnight. And it's very prevalent in the data we're looking at. We're looking at the data that supports the West Coast, a lot of West Coast freight right now. Everybody had been shifting to the East Coast last year. Now all of a sudden it's like, we'll take whatever we can get coming into the West Coast. We're going to pull all that freight into the country. Los Angeles right now is one of the tightest spaces in the country. A lot of long haul freight volumes pushing off the coast right now. And you cannot, you just can't deny it. I mean, we've got, it's not necessarily panic buying, but it's almost panic shipping. They're anticipating further, geopolitical concerns as well as another COVID-19 outbreak. Will they have the ability to get some of the freight into the United States if we have another round of this virus? God help us if we do. And I think that's something to keep in mind for the rest of the year. I think, to the industrial production numbers point, we are sitting on a lot of cash. People are not investing right now. Even though they may be profitable, I've heard a lot of, anecdotal stories about how people are actually doing better now than they were last year. And again, we have data that supports that is entirely possible for a large portion of the population, especially in the transportation space. Sure. Tender rejection rates up year over year. Tender volumes up year over year significantly over 2019. And that's going to drive... This is what drives me into the topic of the day. What is driving rates in the transportation space? We've got a recovering economy, fast in some areas, retail, consumer spending, slow in others. Who has the leverage this year? Who has the ability to move these rates? Now, a lot of people, especially on our social media, get on there and start talking about how brokers are driving rates down. Well, all brokers are doing essentially is providing, transparency, a competitive platform for shippers to bid on freight, and they are connecting the carriers and the shippers. And if they don't like what they see in one carrier, they'll go to the next. Some of these carriers are low-cost carriers. There's a trade-off there. This space is so overwhelmingly competitive. You cannot simply say, take the LTL space. For instance, there's very few low-cost LTL providers out there because it's so expensive to enter the LTL space. Less than truckload LTL. Old Dominion, considered one of the premier LTL carrier in the United States.
Some might say blue chip.
Yeah, it's a blue chip stock for sure. But they're revered in terms of their service, but at the same time, they're not the cheapest carrier.
Yeah.
You can go to them. Conway back in the day, before XPO bought them, was also considered in this same realm. XPO still has this infrastructure embedded in their plate, but it's much more difficult to separate them from the rest. So it's not a pure LTL carrier anymore. But Old Dominion, of course, considered one of the most premier LTL carriers in the country, not the cheapest LTL carrier, yet they still get a ton of freight. And you have to have freight to have an efficient freight network in less than truckload. So who is driving the rates? Who's driving these rate fluctuations in the United States? We've got volumes increasing 6% year over year. We've got tender rejection rates up about 1.5% year over year, or 150 basis points, I should say. We're around 5.1% last year. We're up around 6.6% this year. Not a significant change in terms of tender rejection rate, but spot rates up 4.8% on the long haul market year over year. So most of the stats are supporting a better freight year than last year, except for one thing, Anthony.
What's that?
It's not all about that spot. It's not all about that spot market. And the spot market...
spot was all there was, Zach.
No, the spot market represents anywhere from 10 to 15%, and I'm not going to get into the semantics of defining spot versus contract freight.
You mean there's a whole other thing, contract freight?
Oh my gosh, here we go.
Did we do a series on this?
We did. We did way back when.
There we go.
But at the same time, so contracted rates are typically what we consider, something that a shipper enters into an agreement with a carrier, or a broker that has managed transportation aspect. They have a set rate. They know that going from Atlanta to Philadelphia, they're going to pay $1.60 a mile if they offer that freight to the carrier or the broker.
Right.
Guaranteed. Whether or not they hand that freight off after the fact is another debate altogether. I'm not going to get into that. But at the same time, you're talking about a market where brokers have been beat up for basically saying, all right, we're going to carry this for this and this and this. Spot freight is 10 to 15% of the market, maybe. Yeah. And in a market like this, you're talking about all these bids that went out late last year, they got accepted. Cass, the freight indexes. I'm sure you're familiar with Cass.
I've heard it once or twice.
So they're an invoicing company, and they represent about $30 billion of freight. movement in the United States. Well, Cass came out and their line haul index, so their Cass truckload line haul index. It is simply an index that measures the rate or the amount of spend on pure truckload moves, less accessorial fees like fuel, inside delivery, lift gates, all that other nonsense that people like to spend on top of it. And that declined 6.6% year over year in January, Anthony. Guess what it was in May, year over year? I know I wrote it in the notes, so you could probably answer.
I'm guessing it moved down.
5%.
Jeez.
So we are 5% down year over year. So we actually increased over January. We've increased the discrepancy in year over year rates, by a full percent. So what this tells me, and again, Cass is an invoicing company. They have some spot market influence, but a large portion of what they're measuring is contracted freight rates.
Right.
When you see a massive decline in a single month, especially in the beginning of the year, it's an indication that contracted rates had some contraction.
Gotcha.
So we've already seen a large point of contraction this year.
Yeah.
You know who manages those bids?
Who?
Carriers.
Not brokers?
It's not the spot market.
That's right. It's not the spot market.
This is the contract market.
That's right.
It's the contract market that's determining this baseline for freight rates.
Gotcha.
So spot market rates, again, they go down for a period of time. They pull contracted rates down. Spot rates go up for a period of time. They pull contracted rates up. Last year, we can see that carriers actually set the bar because they bid on those a lot. Again, I'm basically lumping in some of these brokers or 3PLs because they have managed transportation. They basically act as the transportation managers for shipping accounts, taking on the liability or the risk of the freight market without having assets. So they basically bid out. They do the same thing. So if Target were to ask a 3PL to manage their transportation, I want you to figure out how to get all this freight from point A to point B throughout the United States this year all over my network. They will take that risk on. They don't have any assets. They bid that freight over to a carrier or several carriers to ensure that movement happens.
Right.
They are concerned about rates and service. That's it.
Gotcha.
Capacity is in that service requirement, so I'm kind of lumping those two together. But the fact that we already saw rates kind of drop this year is an indication, especially on the Cass line haul index there, which is a very clean, pure number, tells me that carriers are largely responsible for a lot of the rate decline year over year that we've seen. The spot market is up 4.8%, but that's only 10 to 15% of the market, as we know. So, if they stay elevated, I think we can start to expect, like we did month over month, an increase in the line haul index. It was actually 0.5% up from April to May. So again, the longer that the spot market stays over the top of contract, the longer, that means that we're going to see these contracted rates expand. Gotcha. So anybody out there complaining about brokers driving rates down, they are correct to an extent, but it's only because they are just simply adding competition to it. Right. It's no different than another carrier entering the space. It's just like another carrier being like, okay, I'm here now, I'm going to drive this down. Yeah. And they have access to multiple carriers, so right. they really try to leverage the carriers against each other in that regard, but not always, because there's also the aspect, like I said in the Old Dominion example, of service. There's got to be service there.
Standard of service there.
There's service and rates. It's not just service. So, always be mindful of that. And I think this year, again, is more of a product of the previous few years. 2018, super hot. Did you read my article this weekend? I know you were in Boston eating those lobster rolls.
I may have had 1 or 7 in the course of 3 or 4 days. They
are delicious. I do love a good lobster roll. So I wrote an article this weekend, and I basically, I got a little clickbaity, Anthony, basically saying.
I'm all for it.
I mean, I did. Every now and again, I like to get a little clickbaity just to get people's attention, get into the mess for a minute. And I basically said 2018 was actually worse for carriers than 2017.
I remember
20.
seeing that.
So the point is not necessarily that carriers had a bad year in 2018. They had a fantastic year in 2018. But the results of that overheated 2018, we are still paying for today. And if you look at the CAS index there, with that 6% year-over-year decline in January, prior to COVID-19, already happened. We hadn't even barely thought about COVID-19.
Yeah.
6.5% year-over-year down in truckload cost. It's actually gotten better. We've actually gotten better in terms of rates since that point in time. So 2018, all this robust growth, super fast, two major hurricanes, natural disasters sucking up that capacity, ELD implementation, hard implementation in December of 2017, and then again in April of 2018. Tender rejection rates were up around 20, 25%. Mm-hmm. Then all of a sudden, we go back to normal.
Yeah.
We had all these tax exemptions. We had all this new depreciation we could write off. So business investment, all-time high. All of a sudden, all that diminishes.
Yeah.
Everything kind of goes away all at once, too. So it's almost like we were addicted to this shot of adrenaline that has to fade out, and we're still dealing with that. And I think
it really pulled in a lot of folks, right, that succumbed to the industry, and I think that we saw that flushing throughout 2019, essentially.
Yep. And we saw a record number of trucking failures in 2019, which actually, one of the biggest questions I get now is, are we going to see an acceleration of that trucking failure data? And I'm like, don't get too excited, people. I know there's people out there that are excited because they think that this is going to diminish capacity. Look at what the freight market did in 2018 when it got a couple extra dollars. It just went out and bought a bunch of trucks.
Yeah.
They bought too many trucks.
Yeah. Yeah.
And then it depressed rates even further. And it's harder to deal with the contraction of rates than it is the expansion of rates. So getting that 2 to 3% GRI, a lot better than that 10% GRI followed by 8% contraction.
Right.
You know what I'm saying? So,
and we have a couple, real quick.
Let's do
LinkedIn.
it.
Just small stuff. Calvin Johnson says hello from GNR Logistics, Mississippi. Tim Dooner himself says Anthony is hooked on economics and Sour Patch Kids. I haven't had a Sour Patch Kid it's been well over a day, Dooner, right? So how about that? Eric Serta says economists look for human behavioral patterns. Good luck with nailing that down. No joke.
Well said.
Nurfad says, I will take relationship and best performance over crap service and cheap freight.
There you go.
And Anthony, I'm not going to try to pronounce your last name, but he has a great first name. And Anthony is saying hello from Dallas, Fort Worth. But yeah, I mean, I think that is a lot of great information, especially when we're looking at in perspective of what was happening in 2018 in comparison as to what's happening right now.
Yeah. And you can't be prisoner of the moment too much, obviously. You got to look forward. And this year has, a lot of, I'm hesitant to say it, uncertainty.
There it is.
I wish I had like a deeper voice where I go, uncertainty. Left in it. And, we're going to have a lot of fluctuation, variation in the patterns as shippers haven't they don't have a full understanding of forecasting demand. Carriers can't see that coming either. There's going to be some disconnection. Supply chains aren't going to change overnight. But I do have one question for you.
Let's hear it.
Do you like chicken better fried or grilled?
I don't like chicken. Turkey.
Incorrect. It's
Turkey's
fried.
The correct answer.
It is fried all the time.
Turkey.
Grilled chicken is garbage.
I don't even eat birds. I eat fish and seafood only.
But you've had fried chicken.
I prefer turkey.
I don't even understand why we have these conversations.
Turkey.
This is
turkey
ridiculous.
over everything.
Turkey is flavorless.
Get a turkey sandwich, take a nap. Thanksgiving, the vibes.
You know what I use turkey for? Putting other stuff on so it tastes like something.